What do you mean? Where are we in this bull market and a bear market, as Kramer called it this morning?
We're in an oversold bounce. Things just got too negative. Investor mind, Sarah, Mike covered it well. Recession, it's going to start tomorrow morning. The Fed's going to raise rates and until they, wring our necks. The Target and Walmart, the consumer's dead. It just got a little overdone. And so we had a nice bounce last week. I'm not convinced that the bounce is over. Remember, in the middle of March, we had a 10% rally in the S&P and a 16% rally in NASDAQ. It's easy to forget that. I think we could get another that sort of thing from the bottom last Friday, but I don't think we've seen the lows for all the problems you and I both know.
Right. So you're sounding pretty negative. What should you be doing on the bounces? How do you take advantage of those kind of opportunities? Do you de-risk? Do you move to cash? Like what is the advice here?
In portfolios like I manage that are generally fully invested, it's a matter of trading. So that is to say, when we get big bounces, there are always things I want to get out of the portfolio or things that have bounced a lot where the fundamentals might be in question, and you turn around and buy some things that you think provide more stability and resilience. Quality is key, Sarah. Quality of earnings, quality of balance sheet, quality of management in these times when you think we haven't seen a bottom yet and we're struggling with all the uncertainties out there. Political uncertainty, monetary uncertainty, fiscal uncertainty. Those three things rarely all at the same time, and that's creating lots of volatility in both directions.
So it seems like in the large cap value, large cap growth portfolios that you still have a pretty big exposure to communication services and consumer discretionary, both of which have proven pretty vulnerable in these sell-offs.
We are maximum underweight communication services. Not sure what you're looking at. We do own some consumer discretionary. Our biggest overweight, however, tech, old tech, HMOs, and financials, especially insurance.
Hey, Bob, it's David. Taking it back to the macro for a second. Obviously we talk about the impact of higher rates. What about the reduction in the balance sheet? Where are we? I think $8 trillion starting to come down. Does that have any impact at all on the broader markets as well?
Look, the honest answer, David, we don't know. We haven't been here before. The magnitude of balance sheet reduction and the amount of interest rate rises together, I think, create an uncertainty. Look, if all that money the Fed provided by buying that paper helped people risk, you got to wonder if going the other direction is not going to cause markets to de-risk. So I think it's an uncertainty, but a lurking negative.